Well, President Obama, he set up a fresh debate on the nation's debt in his speech yesterday, and he also set a date, June, for when a bipartisan deal should be cut on the fiscal deficit. My next guest says we are headed, though, for a disaster if we don't tackle this now. He's our guest host for the hour, John Mauldin, the president of investment advisory firm Millennium Wave Investments, author of Endgame, The End of the Debt Supercycle and How It Changes Everything. According to who? Newt Gingrich. It's a fun read.
That's what he... Well, not quite what he said on the back, but
he says no one has thought more creatively about the economy. So again, a great little snippet there.
Okay, well there you go. Watching President Obama yesterday, are you any more confident that we're going to get our fiscal house in order?
No.
Why not?
Well, I mean, I think we will, but it's the start of a debate, and it's basically what I was calling for in the book. We have to have a discussion in this country. We have to get the deficit below the growth of nominal GDP. We can run deficits, just like Dick Cheney said. The deficits make no difference as long as they're low. But when they're as big as they are today, then of course they make a lot of difference. So if we bring it back down, which we will in one of two ways, either we make a choice, we get together, we act like adults, or the market says you're not acting like adults, and then we have a crisis. The whole line is that people only really accept change in the face of necessity, and they only see necessity generally in crisis.
Well, speaking of necessity and crisis and debt all together, the debt ceiling argument. We've been talking about this $14 trillion debt ceiling for a while, and people said, you know what, are we going to see the same battle lines drawn that we saw with the federal government possible shutdown? Will it take an 11th hour deal to get that debt ceiling raised, or should it even be raised?
Well, it should be raised. We shouldn't be having the discussion, but the fact is we are. It'll be raised, and I hope we have a fight about it. I mean, the reality is we've got to cut not 600, billion, like Paul Ryan's thing, or the, kick the can down the road like Obama's thing. We've got to cut about $1 trillion from this last budget every year. That's a big number. And we can't get there with either Obama's plan or Ryan's plan. We're going to have a discussion and says, and it really boils down to how much Medicare do we want and how are we going to pay for it?
Okay, but John, why aren't the bond markets yet raising this alarm? Why aren't yields going up 7-8% or whatever?
Well, okay, if you'll go back 3 years ago, the bond markets were telling us that Greece and Portugal and Ireland were in great shape. Not a problem in the world. Let's give them money at 2% for 10 years or whatever. Okay, the bond market is not that smart. When it sees the problem, it goes, oh my God, there's a problem.
But this is all on the front page of the newspapers. We're talking about this every day, day in and day out.
Because we're talking about it. It's not a problem today. We're still funding, we're still going. Remember, the great book, besides my book, but is that a shameless plug or what?
No, that's a shameless plug.
That's a shameless plug.
You have to hold it up now.
Okay, but I mean, really, the best book of the last decade, the most important book, was Carmen Reinhart and Ken Rogoff's book, This Time is Different. And they looked at 266 crises, and so what did they find out? That it's never different. And you go along, and you go along, and you go along, and it's boring, and then bang, it's different.
So when is it different?
I think
the stock market, when is it different?
Well,
like 6 months from today?
The stock market's dealing off of a different dynamic.
Right.
But I think the bond market is 2013. I think in 2013, if the bond market doesn't see some adults sit down and say, let's get this fixed, then the bond market starts throwing out. Now, if Obama and Boehner can sit down, and O'Connell and Reid and all those guys can sit down and do something in June, that would be good. Will they get us there? I don't think so. That would be asking too much going into an election year. But if we can get something, we got to make steps.
Well, we spoke in the last hour about how the economies of countries like Brazil, China, India are powering ahead, and now the so-called BRICS are about to make a play for more political power at the spring World Bank IMF meetings in D.C. That is where Sara Eisen is right now. Sara?
Betty, the BRICS are pushing for more power at major financial institutions like this one, the IMF, as well as the World Bank. Brazil, Russia, India, China, and now South Africa, too. They've been meeting all week at a Chinese resort town. They're coming together to demand higher positions. This according to officials that talked to Bloomberg. In fact, Brazil's president says, we will insist on the fact that governance at the IMF and the World Bank cannot be a systemic rotation between the U.S. and Europe. And look who's on top right now. Robert Zoellick, an American leading the World Bank. Dominic Strauss-Kahn, a Frenchman in charge of the IMF. In fact, all 10 IMF managing directors have been Europeans since the 1940s. Americans have nominated the World Bank leader. They are the biggest share in the World Bank, even though these are technically multi-government organizations. Now, if China does get the top spot at, say, an organization like the IMF, experts say you could see faster action to try to dethrone the dollar. Now, we know China also at this weekend is pushing to be included in the IMF's unit of currency, the SDR, which currently includes the euro, the dollar, the Japanese yen, and the British pound. The facts are the IMF predicts that the BRICS will overtake the U.S. economy by the end of 2014. That's $21 trillion for the BRIC economies, $19 trillion for the United States. They're set to overtake Europe's economy this year, Betty, and the fact that the BRICS have come together, that they're speaking now with one voice on such crucial issues like leadership positions at the IMF and the World Bank, could give them extra clout at these meetings here in Washington all week that are wrapping up in the all-important G20 meetings set to take place here tonight and Friday.
Sara, thank you. Sara Eisen there in Washington. So the emerging market countries trying to vie for more power. We're back with John Mauldin, the president of investment advisory firm Millennium Wave Investments. And John, as you were listening to what Sara was talking about, dethroning the dollar as one concept, you say that's ridiculous.
It's garbage. I mean, someday when, our grandkids are running around playing with each other as adults, maybe. But okay, what have you got to have to be a reserve currency? You've actually got to have some substance.
Right,
You've got to be able to pony up and play.
Okay.
You've got to have a fully convertible currency. You've got to have a currency that everybody looks at and goes, this currency is going to be here in 10 or 20 years. Let's see, is that the yen? Nah. The pound? They're printing. Anybody interested in the euro? Are you interested in the euro with the, no. Oh, let's go to the renminbi.
It's the Chinese yuan. I mean, no, it's not really fully convertible
it's
now.
It's not fully.
But, yes.
Someday it will be. And someday, 30 years from now, when they've got some heft and size and balance to it, sure. But, I mean, if everybody thought, and everybody around the world gets to vote, every central bank votes every day where they think a reserve currency should be. Nobody's piling into the yuan.
Right.
Okay.
But they are piling into emerging markets, and that's
they should be.
And that fact what Sara was talking about. So are you a bull on emerging market stocks over the next 3 years?
I'm bull on selective stocks, number one, but because I don't want to buy like an India ETF today. But with that being said, the next time we see some serious pullback in the emerging markets, in the U.S., I think we could see a decoupling, finally, of the emerging markets and the U.S. And I think that the next run that we see in emerging markets will be an all-time classic bull run. And it could be
in
the emerging markets in general. Okay. And it could be the trade of the decade.
I've got one for Mr. Mauldin. Open Tables, it's a company that does online reservations for restaurants. Stock's up 175% over the last year. Bank of America Merrill Lynch downgrades it on valuation. Something he was talking about earlier.
Yes.
There's a big debate out there. Are stocks cheap right now, or are stocks? I mean, tech stocks might be a different story because they've had a nice big run up. But.
No, stocks aren't cheap right now. If you go to S&P's website and you look on as reported earnings, you find that projected out a year, if analysts are right, we're still in 18, 19, 20 range. I mean, that's not cheap. That's not outrageous.
It's not expensive.
But what happens is markets go from high valuations to low over big long cycles, and it generally takes about 3 big kicks in the head before the markets get to lower valuations. We probably do one more.
Yeah.
We're 2/3 of the way through this cycle. I was talking about it in '99, and people said, "John, you're crazy. It's nothing but up from here." Well, it's not. But it will be someday. So you just have to watch the cycles.
After another big kick.
Now, and I'm talking about stocks in general. Now, you can find stocks in specific that are going to go up. And that's why it's a stock picker's world in the secular bear cycles. In the secular bull cycles, it'll start another, 3, 4, 5, whenever it starts. Then everybody gets to be a genius.
Momentum after that, yeah.
Everything goes up.
Laura, down at the New York Stock Exchange, give us your take.
Hey there, Betty. Well, after a pretty flat close yesterday, we are seeing the selling picking up down here. I do want to point out the Dow, S&P 500, and the NASDAQ all moving lower here. Talking to traders, they've been saying that this market has kind of been stuck in a tight trading range here, looking for a catalyst to either move the market in one direction or the other. And today, certainly that's the initial jobless claims number, that surprise jump in claims, now back above 400,000, raising some big concerns down here about the strength of this overall economic recovery, and continues to show that this labor market continues to struggle here. So a big worry for a lot of traders down here. Also, they point to the signs that Sara was talking about, concerns about the European debt crisis. You still have traders focusing on the situation with oil as well. So given all the uncertainty, you're not seeing a whole lot of participation. I want to point out we haven't seen over 1 billion shares changing hands here at the New York Stock Exchange all month, so well below the 3-month average. Now, technically speaking, traders watching that 50-day moving average with the S&P 500, that's 1314, now below that level. Traders say if we see a close below that mark, don't be surprised if we see the market here testing the March lows once again, right around that 1250 level in the coming weeks. Back over to you, Betty.
Laura, thank you. I want to head over to Chicago as well. Trey Kinnepa standing by of LotusBrokerage.com. And Trey, interesting, he sends talking points, right, before our interview. And you don't like what you're saying is you don't like being played for a fool, right? You feel like you're being played for a fool by the Obama administration. Am I right or not in your notes?
Well, what I find to be odd is that there is not an economist in the world that can show me that if you raise taxes, you actually increase tax revenue that goes to Washington. In every single instance throughout the history of the United States, if you raise taxes, tax revenues drop. They don't go up. So, and if you look at the opposite side of that, if you lower taxes, tax revenues go up. I know it sounds counterintuitive, but look at what the impact on the economy is when you raise taxes. So I just don't understand this continued over and over talk about, we must raise taxes. The IMF has been talking about this as part of their austerity measures to the countries in Europe. Okay. And it just doesn't work.
Okay, we're getting a little off topic on the markets, but that's all right. No, but is he right about that?
That's what the research says. Here's the problem we have, going back to our first segment, is that if we want to have as much Medicare as we want, and all the polls say we want to have this much Medicare, and the polls say we don't want to raise taxes, because even on the Democratic side, those are two incompatible things. Okay. If we want it, at some point, we're going to have an adult discussion of how we're going to do it.
All right. Commodities are at the center of what could be the biggest IPO of the year. Dom Chu back with us with more on Glencore's plans. And Dom, there's a massive valuation attached to this, right?
This could be a $55 or $60 billion company. Glencore is what we're talking about. Glencore, Global Energy Commodity Resources. That's what it kind of stands for here. And what they're trying to do is raise about $11 billion, but not in New York, about $9 billion worth of it in London, and about $2 billion worth of it in Hong Kong. So that's a huge deal. They're trying to raise a lot of money here into an IPO season for a commodity company when commodity prices might be at a near top right now. Goldman Sachs out with a call saying that, we could see some near-term weakness. The commodity run might be over. They're saying kind of underweight or take a little bit of those commodity exposures off the table. As we look at the chart here, we have seen over the past few years here a huge run-up in commodities towards their near all-time highs back in 2008, what we could be due for a pullback. So the question is right now, is Glencore seeking an IPO at a time when commodities are near a top right now? That's what a lot of analysts are saying. And what it really comes down to is what these guys do. They're a huge commodity company out there, and what they do is own stakes in other companies. They're almost like a commodity mutual fund of sorts. They own a big chunk. We're talking 34% of mining giant Xstrata out there. Also, Rusal, the biggest aluminum maker in the world, they own a 9% stake there. They also own stakes in a lot of other companies, Nurstar included. They're a huge zinc manufacturer. So again, these guys are everywhere. And of course, when we talk about Glencore, we're talking about a company that traces its roots all the way back to an infamous name in trading, Mark Rich and Company. This is the company that used to be Mark Rich and Company, changed its name to Glencore after, remember, Mark Rich, the same guy, Mark Rich, that was indicted by former federal prosecutor Rudy Giuliani for tax evasion and trading with Iran at a time when we were supposed to. So again, when it comes to Mark Rich and Glencore, this IPO has a huge history behind it. Mark Rich no longer involved in the company, but again, Glencore, one of those companies out there that traces its heritage back a long way to guys like Mark Rich. So something to pay attention to for sure, Betty.
Okay. All right, Dom, I know you're going to be joining the conversation in a moment. We're back with John Mauldin, the president of investment advisory firm Millennium Wave Investments. He, of course, has been staying with us as a guest host for this 9 o'clock hour. I thought Dom made a good point, though. Is Glencore, though, coming out with this IPO at basically, a moment where we might see commodity prices peaking?
Well, if they are, it's a great time to come out and get people's money. That's when you want to do it. If you're doing an IPO, you're not doing it out of the goodness of your heart to help people get involved. You're doing it to get as much money as you can at the right time. So that tells me that they think it's probably getting a little frothy at the top. The other thing that I would be concerned about when you're talking about commodities is as the Fed pulls QE2 off and they pull QE1 off, what happened the last time? Commodities softened. So
when you take QE2 out?
If I was long commodities right now, I'd think I'd move my stops up. I think I'd hedge it just a little bit, and I'd be more cautious.
Now, when it comes to that commodity run, though, right now, is there merit here to this whole idea that it could be over right now? I mean, the Fed is still pumping stimulus. Central banks still putting a lot of cash out there. There's a reason for commodities to still run, right? There's a lot of cash out there.
There's a lot of cash, and I think long-term I'm a commodity bull. I think the Asian and the emerging market deal is real. I think they're going to continue to grow. If they want to buy stuff, then they're going to need more commodities.
So you're a supply-demand bull.
I'm a supply-demand bull.
This is in part speculation here.
Well, it is speculation, and my favorite way to play commodities is to find a really good commodity trader that understands trends and let them play for us. Because this is not I think I'm going to buy copper and put it into my house like the Chinese are doing.
Well, with commodity traders, is Glencore one of those traders then? Are there companies out there that you might want to invest in if they're good traders?
When Glencore is not a commodity trader as such. When you're buying 20% of this and 8% of that, you're long. You are the market. I'm talking about a commodity trader they're playing the futures or the physicals, and they can get in and out.
John, I think we have to say sayonara.
Oh, it's
Thank you.
way too fast. Way too fast.
It's great to have you guest host with us, John Mauldin, the president of Millennium Wave Investments, also author of The Endgame, The End of the Debt Supercycle.